Been a couple of really exciting sessions. Should one get carried away and participate, or is it prudent to be cautious? Anand Tandon, Director of Equities at Brics, joins in to answer that question. Morning, Anand. What do you think? Is this the start of another big party?
Well, then I'm not the partying type, so the answer with me is somewhat predictable. I think investment is a lot more serious than going necessarily with the flow. At this time, should you go with the flow? I think you don't have a choice. Because for anybody looking at the fundamental situation, you have to argue that the valuations are at the higher end. Interest rates are likely to go up further from where we are, almost definitely. Inflation continues to remain a worry. And the global issues are coming back to the fore. In all of this, it's not a scenario where necessarily you should be very bullish on the stock market. That said, till the market actually turns, as a trader, you should not turn in anticipation of it will, because the last final flush is where you get the big money. But I'm now waiting for that final flush. I'm not necessarily waiting to put fresh money into the market.
Anand, morning, but it's likely there's a final flush coming. I mean, it's easier right now for you to justify a move on the upside rather than on the down?
Not really, but it can happen. And the reason it can happen is simply because of, the fact that the other markets are also not necessarily giving you any positive uptick. Clearly, if you look at the global markets, and obviously we talk about the US for the most part, the signals that you are getting from the market are divergent, right? You can't have both a situation where bond yields continue to move down, which means that the bond market feels that the markets the economy is in really bad shape, and the stock market continues to go up, which essentially should mean that the economy is in good shape. So one of those two signals is wrong. It's your choice to pick up whichever one you like, but historically the bond market tends to get at least the economic direction much better than the stock market does. So one would argue that the US economy at least is not in any shape to go up from here. What does that mean for a market like India? Obviously Europe is in much worse shape, and I think the fears are coming back up again. There have been recent press releases saying that for example, the Greek issues are coming back to the fore. They have been borrowing from the Central Bank of Europe, and they may be hitting a limit there as well. So, you could have a possible resurgence of risk perception from the European banks, especially the periphery. So where does that leave a market like India? Only to the extent that you need to put money somewhere. We are an attractive market. Are you going to make any serious money? Right now, I think the cost of capital for most investors is close to zero. So if you do more than zero, you are better off. So in India, you are likely to do better than zero.